2023 was one of the most challenging real estate markets Northern Virginia has ever experienced. Rates were up, affordability was down, and inventory was down. Yet, with all of these factors at play, the majority of homes went under contract the very first weekend on the market and for above asking price. So, what does 2024 hold? Are prices going to go up? Are rates going to go down? Is the market going to crash altogether? I've got all those answers for you. In today's video, I'm talking with John Meussner with Mason-McDuffie Mortgage. He's sharing insight on what to expect in 2024, both for interest rates and affordability. And he's also going to be sharing a tool that I think is extremely powerful for home buyers, and that is showing you the cost of waiting. You are not going to want to miss this interview, and we are going to get after it right now. So looking into 2024, and I know nobody has a crystal ball, but with your best educated predictions, where do you see the market going this year?
I think home values are going to go up. That's almost a guarantee. We might see a slight seasonal dip to start the year. I think we're already seeing that. The Case-Shiller report wasn't as strong as we would have liked to see value-wise, but I think throughout the year, you're going to see values go up for the calendar year. Again, a lot of how much is going to be determined by what the Fed does and what rates do. I mean, because the Fed rates and the mortgage rates are going to do differing things at differing times. If you want, I can kind of pull up some of the graphics that I have. We can do like a quick little high level view of some of the things I'm looking at, if that makes sense. The big thing this year is going to be what the Fed does when they cut rates, because the more rates go down, the more buyers are going to come to market. And so the market is already starved for inventory, and there's already high buyer demand. The reason I think rates are definitely going to come down and that this is going to happen is really what's happening with inflation. So it's important to know that the inflation numbers that come out today are including the last 12 months worth of data. So when February inflation numbers come out for 2024, they're going to replace the 12-month annualized numbers that include February of 2023. So basically 23's month will be replaced with 24's month. That's how it works. And if you look at how much shelter makes up the core inflation numbers, it's a huge amount. And shelter costs are lagging. Shelter was still elevated in the beginning of 2023, and it's come down substantially. So those numbers are not yet included in the inflation. If you look at the actual shelter numbers, they were sky high in 2023, 0.74, 0.76. So for January, February, even March, you're going to see some really high numbers that are going to be replaced by lower numbers. The numbers now are closer to like 0.2, 0.1. So the 12-month annualization of the inflation numbers is going to make inflation look a lot better in the coming months. And as inflation comes down, always brings mortgage rates down as well. And it doesn't necessarily cause the Fed to do things, because the Fed is always either too late or too early. I remind everybody, it wasn't that long ago in 2022, right? Mortgage rates started taking off when inflation numbers were high. And the Fed was telling everybody inflation's transitory. Don't worry about it. It's just short term. Don't even pay attention to it.
You're
And
right.
here we are, 2 years later, and rates are still at elevated levels due to inflation. So everybody's expecting the Fed to cut rates this year. And this is why these are like the numbers that are being replaced. So you can see these are numbers that are already out and estimates going forward. And these replacement numbers are what are going to be coming out of the inflation data. So you can see like 0.5, like January 24 is a 0.1 reading, replacing 0.5. That's a huge, huge shift, bringing inflation down. And that's going to continue every single month. First time you get a higher expectation is going to be June, and that's barely a difference. Same thing with July, barely a difference. September, we actually saw a pretty low reading in 2023. So that's going to be a month where like inflation even starts to level out, but it should be a straight road down for inflation. And that's what the Fed's looking at. So the Fed's looking at inflation and jobs numbers. One of their mandates is maximum employment. And so they're paying attention to the jobs numbers too, which is why we saw rates spike last week in January's jobs numbers. Their jobs report was tremendous if you just look at the numbers and don't pay attention to what is included in those numbers. But based on what happens with the jobs market over the next few months, we're going to see the Fed cut rates at some point. So there's a chance they'll do it in March. I don't think that's going to happen. 68% likelihood. I would say as of today, it's probably lower than that. I think it's going to be May or June. Wouldn't surprise me if it's June if the jobs report stays strong.
That's great info, because I know a lot of buyers that I've talked to are waiting for that March date, thinking that that's when they're going to be cutting. But it's good insight that you don't agree with that right now.
Yeah, and a lot of people are talking about it, but again, so these numbers that we're looking at, they were before the jobs numbers. Did you see the jobs report last week?
I did look at the jobs report, and then I know you and I chatted about it. And I don't think, were people just not expecting that, or what happened with it? Because so many were thinking that they were even going to cut with this most recent meeting.
Yeah, there was some talk about that, and you can see there was a 7% chance, so we didn't
Yeah.
expect it. But so what everybody was watching was there's these ADP reports that come out, and they're, payroll analysis from around the country, and then there's the BLS report, which is the Bureau of Labor Statistics.
Mhm.
And what's funny is they've both kind of changed their metrics and how they're calculated over the last few years. So it's the expectations versus the reality have just been completely disconnected. And in January every year, they make seasonal adjustments as well. But if you strip out the seasonal adjustments and you look at how many of the job creations have been part-time jobs, it's really negative on how we're doing from a jobs market, right? Like
Mhm.
they celebrate this 300 plus thousand jobs created, but they're celebrating this when the reality is that the majority of the jobs that have been created are people working 2 and 3 jobs to
Exactly.
just maintain. It's scary, but it seems like people react to the headline number. People celebrate that 300 plus thousand jobs created and they say our economy is doing great. Most of it's
But they're
part-time
not digging
jobs.
into the data. Yeah.
Yeah, if you dig into the data, you see that people are working fewer hours each week, multiple jobs. They're working part-time jobs, not full-time jobs. And so it's people are working more out of necessity. So the numbers look good, but the reality is less good. So this is one of the cooler things that's out there. And this is so the Fed does like it's anonymous, but each dot on this chart represents a Fed member. And they basically get together and they just say where they expect rates to go. Again, the other important thing to keep in mind is this is the Fed funds rate. So this is the rate banks borrow from the Fed and the rate at which banks borrow from each other. So this isn't consumer rates. So a lot of people are confused. They think the Fed directly raises or lowers mortgage rates, and they don't. Their policy impacts the economy, which affects mortgage rates. So it's important to understand how it all goes together. But if you look at what the Fed expects to happen for 2024, the majority of Fed members see between a 50 and 100 basis point cut to the Fed rate. There's some outlier members that don't think they're going to cut at all, which I think is unrealistic. And then there's some that think they're going to have to cut a lot. But if you look at 2025, more members see more cuts. In 2026, the majority of Fed members see the Fed rate coming down for the foreseeable future over the next couple of years, which makes money cheaper
Yeah.
to borrow, which brings down the rates on home equity lines of credit. They do this, they cut the rate to stimulate a slowing economy. That's pretty much the reason for the rate cuts. The same reason they hiked the rates to slow down inflation. They basically have to like put the brakes on the economy. And that's because inflation was getting out of control. But as inflation comes down, they need to stimulate the economy. And one of the ways they can do that is reducing the rate at which basically reducing the cost of money. Money's cheaper. I'm going to
Hmm.
go out and get more of it to invest into my business. I'm going to buy more things because credit's cheaper. And so
Gonna go
that's
buy
this
that
is
new
what
car.
there you go. It seems like based on debt right now, it seems like people are buying the new car regardless of how much how
Yeah,
much it costs to borrow that money.
that's another factor that I think the headlines miss. And I know that you can speak directly on that with the amount of debt people are carrying right now.
Yeah, if you look at the amount of debt, specifically credit card debt, I think it's at a record high right now. If it's not, it's very, very close to a record high. And on the flip side of that, the amount of savings in the US is at or near an all-time low. A lot of people living paycheck to paycheck, financing. It seems like if you just look at the numbers, and I don't know the reality for everybody out there, but if you just analyze the numbers, it looks like a lot of people are financing their lifestyle right now. Retail sales are still up. Consumer confidence is probably higher than it should be. And people are still spending money, but they're spending it on credit cards. You see the credit card debt just continue to rise each and
Increase.
every month. Yeah.
Yeah.
Fortunately, as the Fed cuts rates, it's going to make that money cheaper too, because the Fed funds rate is
It's
directly
true.
tied to the prime rate. So that rate your credit card's based on, if the Fed cuts rates, credit card rates are going to come down. That's one silver lining.
Positive news there. Yeah.
One silver lining, yeah. And so the Fed cutting rates is going to help because again, they do this because inflation is coming down. And with inflation coming down, mortgage rates are going to come down. And when rates are going to come down, it's estimated, I saw that a 1% drop in interest rate. There's different numbers from different sources, but the consensus is kind of between 4 and 6 million additional buyers come to market for every 1% that rates drop. Some people are closer to that 3 to 4. Some people say 5 to 6 million, but it's somewhere in that 4 to 6 range. And this is
A
really
lot of
important.
buyers.
A lot of buyers, lot of buyers. And this is the issue that we have. If you look at headlines, you see these headlines about inventory climbing, right? More homes are coming to market, inventory is going up. And that's true. If you look at this bounce, 2024, we're seeing similar numbers to 2023. But if you look at all of the years before COVID and before, the economy basically was forced to shut down for a bit, we're basically halfway to where we need to be for a balanced market. Look at how high the inventory was in 2015, 2016, 17, 18, 19. This was all pre-COVID. I mean, what's that, 2/3 of the way back to 2019?
About, yeah.
So we're 2/3 of the way back to 2019, but let's look at what's happening to our population demographic. This is household formations. That is the number of people that need to buy homes. So the easy way to understand a household formation is you've got two families, their kids meet, fall in love, they want to move out and get their own house. Well, the two families, they still have their houses. The children now need to have another house. So that's basically how a household formation works. And it can happen a bunch of different ways, but that's the simple way to understand it. But if you look at what's happened to household formations, they've climbed substantially. And in the past few years, they continue to climb. So the demand for housing is going to continue to climb at very high levels. And the amount of homes being completed for them to buy is not changing nearly as much. It's starting, but we're not there. So supply and demand is just very out of whack. And anytime you see that, it's pricing pressure. If we see rates come down, which we think will happen, we have limited inventory and builders can't just build homes tomorrow, right? Even if they start 3D printing houses in a week, you still need to pull permits for the developments. You still need a lot of things happening that take an awful lot of time. And usually it's a year plus, more than a year in almost every realistic situation, from when permits are pulled and approved to when ground is broken on new homes. So we kind of know what's coming in inventory. And we also know, based on these population demographics and the forecasts and what we know is coming down the pipe in housing, we're just going to continue to have an inventory shortage. And that only leaves one way for home prices to go up. It's going to happen. So all this to say, home prices are going to climb. We do expect interest rates to come down, which that's the good news, right? Because it's going to make monthly payments more affordable. But you might be trading that lower monthly payment for needing a lot more money to get into a house, because we're already seeing the return to bidding wars, multiple offers. People have to pay over list price, over appraised value just to get into a house. The really good news, though, is if the people do that, those people that can get there, right? It's going to be a challenge to get into a new home as a buyer. But if you can get there, we should continue to see prices climb too. So they will benefit and recoup some of that money that they have to spend. Yeah, exactly.
I'm glad that you brought up inventory and interest rates. That was one of my questions. Do you think we have an inventory problem or an interest rate problem?
Yes.
Both?
Yes. And I would say we have both. So we have the inventory problem that I just showed you. We're just too short on inventory. The solutions that the government's coming up with is to allow people to, build ADUs and sell ADUs and zone ADUs in their house. But not everybody wants to live in an ADU. A family of 5 isn't going to live in a 2-bedroom mini home in somebody's backyard. Like, it's just not going to happen. So single family housing demand is still going to be high. And again, you've got to get the permits, you got to get them approved, you got to go through all the environmental stuff. Then you've got to start building. And so it's just very volatile. And builders are still, I think they learned from the real estate collapse. You can't just put out 5,000 homes as spec housing and just hope they sell over the course of 2 years. You really have to pay attention and build according to the demand, but they're still playing catch up. And so the interest rate problem is, it's just made things not unaffordable, because they're still affordable. Nationwide, wages have actually climbed enough, if you look at the statistics, to keep up with interest rates and housing payments. And that's why we haven't seen a slowdown. That's why we haven't seen values rates were up in the 8%, because wages have climbed nationwide enough to where it's really, really tight, but people are still able to get into homes. And so they're still buying. So the challenge I think we're going to have is, as rates fall, millions more people are going to come to market. And that just tight inventory environment is it could push us back to like 2021, where every house that came to market that's priced decently and shows well is going to be a bidding war. And it's just going to go to the person that has a ton of extra money to throw into the pot.
Definitely speaking on the market here, we're already seeing, I know last weekend of multiple homes in varying price points, and it was 25, 35, 40 offers. And I think you make a great point. I mean, that many offers is really not good for anybody. It's awful sorting through them and hoping that the seller goes with the right one because things happen. I think buyers are reading headlines and going, oh, the market's slow. Maybe I shouldn't buy. When in reality, that's not what's happening. And it doesn't look like there's, going to be this flood of inventory anytime soon. So it's going to get worse.
Yeah, and there can't be. And that's the thing. They see like inventory is spiking, but as we showed, like, yeah, inventory is going up. That's true. The context is important. If you put that into context of the
Yes.
inventory that's needed and the inventory we've had historically, yes, inventory is climbing. It needs to climb a whole lot more before supply and demand is even close to balanced.
And you make a great point, even close to balanced, much less a buyer's market.
Yeah, and you see seasonal dips, right? So you do see these seasonal things, and we see them every
Right.
single year where there's a time of year where homes sit on the market for longer. There's seller concessions, and then buyers make the mistake of thinking it's a buyer's market, and once again think they can take their time. But as soon as that seasonal correction takes place, we're right back to bidding wars, and that's what we're seeing today. You probably saw it in your market. What was it, October? I think when we started seeing like seller concessions, days
Mhm.
on market crept up a little bit, and for some reason it happens every single time that time of year. And I think it's because less people move. Schools have already started, right? So the parents that wanted to get their
I
kids
agree.
into a new school before school started August, September, that increase in activity has already taken place. So you start to see home sit that usually lasts, until the holidays. This year it was like New Year's Day, and the next
Yes.
2 weeks it was like every
Started.
buyer came out and they were like, hey, we're ready to buy again.
I agree with you. I think it came a little on the early side this year. Normally, at least here, we typically see it right after Super Bowl weekend.
Mm-hmm.
And not this year. It was just immediately after the holidays. Buyers are back in the game and looking to secure a home. And it's competitive even now.
And I mean, to give people an idea of the competition, like I reached out to a couple agents yesterday in different markets that I work, and one of our customers just unfortunately was not selected as the winner of a bidding war. I reached out to the agent and just asked, how many offers do you have? And she had 11 offers, and the majority of them were over list price. And
Yeah.
we have a client that's a wonderful client in a normal market would be able to get a house no problem, 800 credit scores, good income, qualifies no problem, plenty of money to put down, and just got crushed by all these other offers. Another one in my neighborhood, I just reached out to the listing agent and they had 8 offers, and it's $500,000. You had 8 people that were competing
It's a
for,
lot.
half million dollars. It's not a small amount
No.
of money. People have it and they're spending it.
Yeah, I agree. They do. And they're waiving contingencies in some cases too, all of them again.
Yeah. I mean, one thing, just kind of a quick pitch for what we do to kind of help with that is we do actual underwriting for anybody that comes and gets pre-approved and decides they're going to work with us for their home purchase. We put them through underwriting. We don't even mess around with like a pre-qualification. I'll do a pre-approval where I get their documents, but we're putting them straight into underwriting because we don't want them to have a mortgage contingency. I think
Exactly.
the appraisal contingency is going to be that's going to be the one that's tough this coming year because people are going to have to start
Yes.
spending over list, and sellers are going to start wanting them to waive that appraisal contingency, which is going to be their only real protection when they put that offer in. And that's where it's going to get interesting. There's really no need, if you go through underwriting, to have a mortgage contingency, in my opinion, because the appraisal contingency is protecting you on value. You're still going to have an inspection contingency for anything that needs to be repaired in the home. But as far as the loan falling through, the only thing that could make the loan fall through is really title. What we're seeing now is some areas where people can't get insurance, or they have to go through like
Mm.
government state sponsored insurance. But it's basically title, insurance, and appraisal are really the only 3 things that we don't know once they go under contract if they've already been through underwriting. So it helps to remove that contingency, but I think we're gonna see it get back to no appraisal contingency. People are going to go in crazy with no inspection contingencies again.
Mhm.
It wouldn't surprise me at all if we ran into that again this year.
I think you're right. We're seeing it here, not in every area here, but in a lot of them, it's back again, where it's just completely waive everything, go in, 20, 30,000 above list, and then also tack on an escalation addendum from there and hope for the best.
Yeah, and then you find out 5 other people did the same strategy. And it's like,
Exactly. Everyone's
you
just
know,
shooting in the dark, and
yeah. And then
sometimes it comes down to a couple $1,000s.
well, and then you have that one person that's working with a brand new agent that's inexperienced, and they're just like, I think I want to lowball my offer. It's like there's always like that
There's
one
always
offer
that
where
one. Exactly.
it's like 10K under the purchase price, and it's just like I saw on Zillow that the house sold for less
Oh.
2 years ago. So
I always say, like, especially with first time home buyers, sometimes they need to just cut their teeth a couple times before then they're like, okay, what do I need to do to win this house?
yeah.
Because, they're reading the headlines that we're talking about, and I can understand and respect that. But then when they get blown out of the water a couple times, they're like, all right, I've had enough of this. How do we get this house?
Yeah, and I use the analogy of like getting punched in the face. Like sometimes you have to get hit a couple times before you're just like, oh, this is not gonna work. Like
Okay, yeah.
I'm gonna have to. Like I went into this with the mindset of like, I am not overspending for a house. And then you find that perfect home, you get excited, and you find out that you just got your ass kicked really when it comes to the other
Yeah.
offers that were put in. And it's like that happens once or twice, and then they're just like, okay, we'll spend extra, overspend on the
I
home.
love the quotes. Yeah, because is it really overspending? I mean, how many people bought anytime really in the past 3 years that thought, oh, I'm overspending, I bid up 100,000 or more above list, and actually turns out they didn't. They still have enjoyed that appreciation.
Yeah, it depends for everybody. Everybody's situation is different. But if you're buying to do a fix and flip, like might be a tough market for that
Yeah,
unless a home needs a lot of work or a complete renovation. But if you're buying a home to live in for the next 5+ years, it's hard to overspend. You can, right? You have to be smart and you have to work with a good
sure.
agent that can guide you appropriately. Don't just say I have, $200,000 in my retirement, so I'm just going to spend all of that. But you might have to get ultra competitive and you might have to spend more than you wanted to get into the home. Almost everybody I know that's done that over the past 3 years has recouped whatever they've spent over within the first six
Mhm.
to 12 months of living in the house just due to appreciation. And that's before they go to do their taxes next year and they realize, like, oh, we get deductions for interest. Oh, we get deductions for real estate
Yeah,
taxes. Oh, we get all these other perks of home ownership that we didn't get when we were renting. It ends up being a really smart financial move, even if they overspend.
I agree. What are you telling buyers right now? Like, let's say you have a buyer that says, I'm just on the fence. I'm waiting for rates to go down and I'm waiting for prices to go down. What process do you take them through to show them that in most cases, that's not a good idea?
Yeah, in almost no case does it really make sense. I have somebody that right now it's actually a buyer that's in a rental situation and they're actually in a pretty good rental spot. The person that they're renting from is giving them rent at about 30% of what the market rates are.
Wow.
And so in talking with them, the conversation's different than talking to most people. When I'm talking with them, I'm just like, you know what, waiting might actually benefit you if you can just take what you would be spending on rent or a mortgage and just sock away. But that's somebody that can sock away thousands of dollars a month
Right.
very easily. And she also has said, like, this is was supposed to be and is still supposed to be a temporary situation. Like my rent's either going to go up or I'm going to have to get out of here like within the next year. So it's almost never a good idea or beneficial in this market to wait. If you want to have a cost of waiting tool, we actually use data and I can show you a few
Yes, I
examples of that.
love that tool. You have helped so many of our clients because of that tool. And I think that it's something that really sets you apart because I don't see a lot of lenders using this to be able to educate clients and help them make an informed decision.
And I think the problem is, or the challenge is, most lenders don't understand. Like most mortgage people do not have like a financial advisor perspective. And I'm not a financial advisor, but I do talk to people about their big picture and I look at more than monthly payment and rate.
Yes.
And we'll probably get into some of the mistakes that buyers make later. But so many buyers are focused on the wrong things. Their loan officers and their lenders are as well. They all talk about Amanda sends a referral to a loan officer, and that loan officer has a conversation with the customer. They say, this is what your rate's going to be. This is what your payment's going to be. They pat them on the butt and they say, come back when you find a home. And the conversation never goes beyond that payment. And that's where the mistake happens. So this is actually a local listing. I believe this property might be pending now. It was recently listed. I don't know if it still is. So if you look at the equity change from buying now, we basically set a timeline. I'm always very conservative in the numbers that I use. So I have the option, I can either use appreciation forecasts to see what the appreciation numbers are going to be. or I can use historical appreciation for a given market going back 50 plus years. And I use the most conservative of the two. So you're either going to get the 50 plus year appreciation average for that market if it's lower than what's forecast, or a forecast, let's say it's an area where building has really taken off and there's a ton of inventory. If the forecast is lower, I'll use the lower figure as well. So I try to make
Okay.
renting and waiting look as good as I can. And I just give people that disclaimer because the numbers are usually even better for home buyers than what I show. But so we set a time threshold, and this is what people miss out on. They miss out on the appreciation of the property, and they miss out on the amortization, which is when you're paying your mortgage, you pay a huge chunk of interest, but you also pay principal. And that principal is freeing up equity in your home and growing your equity and growing your net worth each and every month. And that's a part people just don't get from rent. So it's, you get none of this, zero. This 40K for appreciation, zero if you're renting. All 40K goes to the landlord though.
Yeah, the
Uh,
landlord gets it.
yeah, you start paying on that mortgage. Yeah, you're paying a lot of interest and the mortgage payment's high, but a portion of it's going back to you each and every month. And the way mortgage amortization works, the amount that's going back to you increases with each monthly payment. You start off with the most interest you'll ever pay on your mortgage is in payment one. Payment two, it's a little less interest, a little more principal, and that just continues throughout the loan. This is the estimated home value appreciation forecast. And so I don't really pay attention to the 6 month period because most of the time when people are leasing or renting, they're going to do it for a year. Everybody's doing
True.
a year lease. So if you decide to rent or you decide to wait another year and renew your lease, you're looking at the 1 year. And for this market, the appreciation estimate that we had was 4.5%. That's about where we were last year. Remember last year, most of the year rates were in the sevens and eights. And so again, I think if rates go down to the fives and sixes this year, this number could very, very easily move up to 6.5. But again, being conservative, just buying this house today at 875 and doing nothing other than holding it for a year, you're going to get that 40K just by buying and holding it. And then what I talk to people about is, what are you waiting for? Are you going to work on improving your credit? Maybe you only have 5% down and you don't want to have PMI. So you're going to wait until you have more money saved to buy the house. Well, a couple things when that's the mindset is, by the time you save that money, look what's happening to the home price, right? Like all that money that you save is really for nothing because you're just going to end up spending more on the house. That 5% that you have saved on 875, you save more money. It's just going to be the same percentage on the 915 amount that you're going to have to spend
Right.
next year. And then the other side of it is with these types of numbers, right? 40K, because that's between 3 and 4 grand a month. So let's just do 39.5 divided by 12, right? You're talking $3,200 a month. There's nothing you can do to your credit that's going to change your payment by $3,200 a month. There's nothing you
It's
can
huge.
save that's going to cut what you're spending down by 3,200 a month. It's just not. You're going to lose financially by waiting because nothing you can do to improve your situation is going to save you as much money as these houses are appreciating right now, month over month.
Yeah, that's a big number. And
Yeah,
you're
and it's
going on the conservative side.
I'm going on the conservative side. If you look at getting in today, again, if you get in today with where the rates are, we're doing most of the mortgages we're doing right now are fixed rates. So a payment can fluctuate based on insurance changes, tax changes. Those changes are usually a few $100 a year. So it's, nominal on a monthly basis. But if you get in today and rates do what we think they're going to do, you're going to see that appreciation go up and you're going to see your payment go down. And so
Hmm.
the estimate is, payments should be lower a year from now. But are you going to wait a year to save 6,000 a year when it costs you that $39,500 to save that? Like it's
Doesn't
just
make
not
sense.
worth it. No, the numbers don't ever work out to where waiting makes sense. The asterisk is in this kind of market where we're seeing appreciation, where we expect rates to go down.
Right.
It makes so much sense in today's market to buy and buy soon. None of these numbers, your cash to close, if you wait, it's going to cost you $4,000 more to close. So again, do you have an extra $400 a month to throw into savings? Most people don't right now, right? We just talked about people
No,
living on
you're
credit
right. They
cards.
don't. They're
So if
barely
you don't,
making ends meet.
yeah. So if you're not going to save $400 a month, you're going to be in the negative when you go to buy because you're not going to have as much. So the net cost of waiting on an $875,000 home today, waiting for a year,
Ooh,
is going to be about 40K total. It's a lot
that's
of
a
money.
lot of money.
It's a lot of money. I talk to people all the time and I just say, look, do you want to add 6 figures to your net worth when you retire? Everybody says, of course they do. Who doesn't? All you have
Right.
to do is buy a home today. If you don't do anything else, just buy a home over the arc of time. That home appreciation and the different benefits that you get will work. So we go through all of these numbers with people and we break things down. And a lot of times, like when we were doing this exercise from 21 to 22, we were actually seeing the payment forecasts were way higher, right? Like your payment next year is going to be way higher. The appreciation was going to be way higher too. It was just like, it never makes sense in any market that we've seen in recent history to not buy and buy quickly. But we break this down with everybody. We go through the monthly payments. We go through the appreciation forecasts. I show them, if you could save an extra 10%, what would that look like in terms of the cost savings? And in almost every case, it benefits to buy and buy soon. So we did this other example too, another home in the same market. And you can see again, the cost of waiting. The price point was close, but it wasn't exact. But the cost of waiting for a year was still $40K. And you can see if we go down, this was almost $70,000 cheaper, the home. But again, because of that appreciation, because of the amortization, the total difference, the total cost of waiting ends up being $33,000, almost 3K a month.
It's still a huge number.
It's enormous. I mean, what's in your market? You would probably know this better than me, but like, what would you say is a good, you're not in the super wealthy class, but you're like upper middle class. What would you say a salary is?
150,000.
Let's double that. So if you're making 300K, you're a high earner in your
Yeah, or if
market.
you
Would you
have,
agree with that?
I do agree with that. Or if you have two people in a household, each makes 150.
Okay.
If you're
33K.
doing it
So
on your own at 300, you're up there.
if you're a high earner, right? If you're doing 300K plus, and this is 10% of your salary, are you going to get a 10% raise next year? Probably not. Are you going to get a 5%
No,
raise next year? Probably not.
not here.
If you want to give yourself a 10% raise year over year, buy a house.
Buy a house.
Buy a house.
And you even have in there the cost to refi if rates do go down, like we think they will. You're even banking that in there as well.
Yeah.
Like you couldn't be any more conservative.
Yeah. Because again, I don't want anybody to ever make a mistake. I don't ever want anybody to say, like, oh, I shouldn't have bought that house. Or John said this should have
Right.
happened and this happened instead. And I always under promise and over deliver, right? I'm going to tell you that this is
Yeah.
what's likely to happen and it's going to be better. And you're going to be like, oh, John said I was only going to make this much money and instead I made all this money. I would much rather people have that thought cross their mind than John was just trying to get a loan done. So he told me I was going to make, $60,000 and I only made 33.
Exactly.
That's how we try to frame it for people. We only want things to be better than they expect. This whole cost of waiting thing, it just doesn't make sense because if you look at this $775,000 home, it's going to cost over 800,000 before long.
Yeah. On the low end.
On the low end.
I think that's the part that really gets me when you are displaying that this is on the low end and you're talking 30 to 40 grand.
Yeah, this is assuming rates go down. I mean, you could see this is an expected 1% rate drop. That might be realistic depending on what happens with our economy. I mean, if the Fed has to start buying mortgage-backed securities again, most people think rates are going to be in the high fives. I could see them going lower than that. Disclaimer, I'm in the minority of thinking that, but I think we could see low fives, high fours, just because
that even scares me hearing you say that, just knowing how many buyers will flood the market.
More buyers will flood the market. That will be partially offset though, because more sellers that are sitting on their 3% mortgage and not willing to move right now will, I think, eventually sell. If you can get people into that high fours, they're going to trade the threes for the fours. They're not.
Do you think that will create a large amount of inventory?
It will, but we also just looked at the fact that we need a large amount of inventory just to get a balanced market. So you also have to consider, like, yeah, you're going to have inventory tick up, but again, that statistic where every 1% drop in interest rate, you've got, are 6 million more homes going to come to market?
Right, and
probably
those
not.
Sellers are going to be buying in most cases.
Yes. So there's no way out of the inventory crunch right now. There's just not any way that I can see that we get out of this inventory crunch quickly, which is why I think values are going to keep climbing, which is why I think it's a good idea to buy sooner than later. When people ask, like, when is the best time to buy? Is it the right time to buy? The answer is different for everybody. The best time to buy is 2012.
Yeah.
That's the best time to buy. If you've got a time machine in the garage, go back to 2012.
Let's head back.
Pull the trigger, get your house at a 90% discount, and then ride the interest rate wave down.
Those prices then, wow.
If you can't do that, then today is probably a good option. It's probably your second best option. And that's just the reality where we are.
You and I both know we're in it every day. This is a very challenging market. I would say that it has been really since COVID. What are you seeing as far as mistakes home buyers are making right now?
One of the ones that I've seen recently that really costs people a lot of money. They make a lot of mistakes out of ignorance. They just don't know, especially first-time buyers, like the way to do it, or they follow the media. I mean, that's the thing. Like, I forget the exact phrase, but it's like, don't attribute to malice what can be explained through incompetence. And I think that's like the media, right? Like the media celebrates the jobs report numbers. They don't understand what's in the jobs reports. They highlight inventory spiking, but they don't understand historical inventory and the demographic information that we look at. So I think a lot of people, because they follow these sources, they wait until they find the home. The perfect home pops up on Zillow and they say, oh, I better call a realtor and I better call a lender today. And by the way, I want to make an offer tomorrow. If that same person would have reached out to us 90 days to 6 months before, we would have had time to work on anything that needs to be worked on with credit. We would have had time to look at a lot more programs that they may be just outside of qualifying for, but with a little bit of work they could qualify for. Maybe it's paying off a debt or two to get their debt to income ratio down to fit into a certain product. Maybe it's trying to find a cosigner or a gift from a family member, things that usually take some time and conversation. When they rush it, they don't have time for those things. And people don't realize, like, if you have a 670 FICO score, it's not a terrible FICO score. It's okay. But if you have a 700, you're going to save thousands of dollars on your mortgage. And if you can get the 740, or 760, you're going to save thousands of dollars on your mortgage. We see it all the time where people have a collection account that shouldn't even be there. It's an error. I just had a customer that came to me and the credit monitoring system that she used didn't monitor the credit bureau where this collection was being reported to. So she had no idea this was even on her credit. And when we ran
Wow.
it, it had 2 out of the 3 bureaus had her credit scores in the low 600s. And then the one bureau that didn't have that collection was like 700 and change. And we use the middle score.
Huge
So we're
difference.
looking at those two. Yeah. So we're like using a 630 FICO score when her credit scores really should be in the 700s. And thankfully, with her, we talked with her early on in the process and we had time to get it removed. We had time to get the credit scores updated and thousands of dollars because of that change. Stupid collection account that shouldn't have been there. She waited till she was ready to put the offer in. We wouldn't have had a lot of time to get that corrected.
Yeah, you wouldn't have had the opportunity because the house would have been gone.
Yeah. So waiting is one of the biggest things, waiting till the last minute, making your first step, like looking at Zillow and finding a house. Like a lot of people have that being like step one when that should be step 10. You should already have your loan officer in place and know exactly what kind of mortgage you're going to use. You should have a really good realtor lined up that is experienced. So that's another, I would say, if I had to do the top 3 mistakes I see: people waiting too long, people using inexperienced or not very good real estate agents. The difference between a good agent and a bad agent is that $40,000 that I just showed you,
Yeah.
because the commission's going to be about the same to the agent, whether it's a great agent or a terrible agent. You got these realtor lawsuits going on, and I would say that's one of the viable complaints that the plaintiffs have, is that somebody might not have even gotten good representation, and that
It's true.
shoddy representation got paid a lot of money. You have to work with an experienced agent that knows the market, that can answer questions and can also say, I don't know, but I have this lender that can help you, or I have this inspector that can answer those questions. I have this contractor that can let you know what these renovations are going to cost. In this market, again, if you're working with a buyer's agent that's inexperienced and you're up against 15 other offers, and 5 of those offers are with a top-notch agent that knows what they're doing, knows how to communicate with a listing agent, knows how to find out what the seller wants and needs to accommodate them, those are the ones that are going to win. And the
Yeah,
people
it's
working with
true.
inexperienced agents, they're not going to get the house.
There's too many details that go into it when it's that competitive.
Yeah, there are. I've seen a lot of agents, like the really good agents that I work with, it's always a collaboration. It's like I want to talk to the listing agent. I want the listing
Yeah.
agent to know, like, so a lot of times, especially working on the East Coast, like people think I don't know what I'm talking about because I'm in California and they see that on my pre-approval letters and stuff. And so I'm that out of town slash internet lender. But when I talk with the listing agent and explain to them, like, I'm from the market, I have most of my clients in the Northern Virginia market. Like, I have a huge pool of business there. I know what I'm doing. And also, I know how to communicate and I know how to answer questions. I'm not going to give them buyer information,
Yes.
but I'm going to let them know what our pre-approval process is like. I'm going to let them know the client's already been through underwriting. I'm going to let them know we're flexible on timeline. As far as the loan, it takes us, once somebody's through underwriting, how quickly can you get me an appraisal, right? It's not going to take me 30 days. Get me appraisal and title and we'll get it closed. Those conversations that we have are usually based on an introduction from the buyer's agent that will loop
Mhm.
us in, connect us with the listing agent. Inexperienced agents don't do that. Like, they'll submit an offer and then I'll hear from them a week later and they'll be like, I don't think we got it. And it's like, well, did you
Yeah.
follow up? Did you talk to the listing agent? Do you know anything about the seller? It's like, no, I have no idea. But we sent in the offer. Like, I did know how to fill out the contract. I did that.
Yeah.
And that's where it's just like, man, like these buyers, like if they were working with a better agent, they'd have better luck with their offer. And I say that it's the same way in lending. You got to find a good lender too, because a
Absolutely.
good loan officer, the difference between a good loan officer and a bad loan officer is similar to a good agent and a bad agent. You might still get the transaction done. They might still like do the job, but the customer's not going to end up in nearly as good a position as they would otherwise.
Yeah, there's going to be money left on the table.
Yeah. And again, like I have seen agents go in with customers where they just tell them to bid up, and that's their approach from the start. And I do think customers will sometimes spend way too much money on a house, way more than they needed
Mm.
to, because the seller might not have been looking for that dollar amount. The seller might have been looking for a rent back.
Right. What is
The
the
seller,
seller looking for? What do they want?
yeah, the seller, again, if you're talking about school years and things like that, the seller might want somebody that's going to accommodate them time so that they don't have to pull their kids out of school or drop their kids into a new school mid-year. Like that might be the most important thing to the seller, even more important than $10,000.
Hmm.
But the agents have to know how to communicate to find that
Yeah.
information.
Have to find that out.
Yeah. And so that's really important. And then I think the other mistake a lot of people make in this market, we just looked at this 40K a year appreciation. A lot of people get hung up on their interest rate when they're
Okay.
shopping for a lender. People don't realize kind of what goes into an interest rate in terms of the experience of the loan officer, the expertise in being able to advise a customer and get them into the right product. I mean, I've seen a lot of people, I've seen some loan estimates that get sent to me. And what happens is like I'll talk with somebody and I'm just throwing out example rates. So all the compliance nuts out there, like relax. I'm just using samples here just to prove a point. But let's say, I'm talking with somebody and I say my rate's 6.75. I've had people come back and they're like, hey, I'm shopping and this other lender's going to do a 6%. Sounds a little too good to be true. Let's get some details on that. And what I'm seeing is there are actually lenders out there right now that will like literally just put that hook out there for the low rate and not even let somebody know that they're putting them in an FHA loan when they qualify for a conventional loan, and that they're going to have PMI when they don't have to have PMI with a conventional loan, because they know people are so hyper focused on rate. The buyer thinks they're winning. They're like, oh, this guy's at 6% when you're at 6.75. And it's like, yeah, but conventional is going to have lower PMI. You're not going to have to refi to get rid of that PMI. You're not going to have the 1.75% fee that FHA charges financed into your loan that's going to eat into your equity on day one. But they're so focused on that rate that they're just like willing to jump into that lower rate product, even though it's the wrong product for them.
They
And I
don't
see that a
know what
lot.
they don't know.
No, they have no idea. And
Yeah.
everybody has been so taught to shop based on rate. It's just a bad way of doing things. The best thing to do is I encourage people to shop. Everybody I talk to, I'm like, shop around, talk to some different people, have a conversation with one loan officer, and then have a conversation with the other. Ask the same questions. Ask about the market. Where do you think rates are going to go and why? Who can communicate intelligently with you about that? Who can explain it? Who makes you feel comfortable that you feel you can trust to help you make financial decisions? Because a good lender is also going to help you with the loan to get into the house. They're also going to make your phone ring the second you can save money.
Yes.
And
Talk a
that's
little bit about that because I think that's very important and not something that gets talked about nearly enough.
one of the things that we do is, and again, I'm just speaking from personal experience, is I want to make sure that the people that work with me are always in the right product. I don't work for a bank, so I don't care about the bank's products. We don't service loans. I don't care about the loan servicer product. Like I'm not trying to keep you in that 8% mortgage for a second longer than you need to be in it. So we're constantly monitoring, is there an opportunity? If I see a day where there's a lower rate and it might only be a quarter to a half% difference in rate, but if I can get that for you and it's not going to cost you anything because there's a lender rebate that can cover closing costs, I'm going to call you and say, do you want to save $100 a month? I already have all your information. I already
Yeah.
have everything I need. Like just tell me yes. And everything's DocuSign. It's like the loan process is maybe a half hour of effort for a borrower to do a refinance in reality, assuming, most people with easy to
Right.
document income, that type of thing. It's about a half hour effort to get me what I need. I can verify your employment electronically, your income electronically, your assets electronically. I don't need you to send me bank statements. I don't need you to hunt down your last 2 years tax returns. I don't need any of that. We can do it very quickly and easily, but we're always looking for that opportunity. And new products are coming to the market all the time. Investors are rolling out like loss leader products where the rates just might be really good for a month. And if somebody can benefit, they're going to know about it right away. And a lot of lenders don't do that. Lenders and agents
They
are
don't.
notorious for not following up with their
It's
customers.
true.
That's just a large segment. That's why if you interview home buyers, they might have loved their lender, they might have loved their realtor, but then they use somebody else when they had to sell or buy or get their next loan. And it's just because, they're getting postcards, they're getting bombarded by marketing. And if you're not keeping in touch with people, then
Yeah. So many never hear from them again.
Yeah, they're going to go elsewhere. So we have an approach where I also want to know what people's goals are. What are your financial goals? Is your goal retirement? Is your goal saving enough to put your kids through school? Do you know about all the different cash out options? That's the other thing I see lenders do right now. They're offering people cash out refinances with thousands of dollars in closing cost. They're trying to get people to go from their 4% rate to a 7.5, 8% rate. And that's fine in the right situation if it makes sense, right? If you're replacing 30% credit card rates
Sure.
with that seven, it can make sense. But for most people, a home equity line of credit has little upfront costs, especially compared to a full refinance. And you can
Yeah.
accomplish a lot of the same goals. But the problem is a lot of lenders don't offer home equity lines of credit, where they can only make a very little amount of money. As a loan officer, I might be able to make 15% of what I can make with a refinance using a line of credit. So I don't want to do the line of credit. So there's people that'll steer people into these loans that just aren't right for them. And people are focused on rate, which is 20 bucks, 30 bucks, 100, 150 bucks a month. People get focused on that when the wrong decision and working with the wrong person can cost thousands of dollars extra
Mhm.
and cause you to have to need to refinance again and spend thousands of dollars to later get into the right program. So it's like,
Exactly, to correct the mistake.
yeah, it can be very expensive because we're not talking about hundreds of dollars. When you talk about buying a house and refinancing, you're talking thousands and thousands of dollars.
It's such a huge investment, and I don't quite understand the thought process on why not have this team in place that you know is experienced, knows all the ins and outs. It shouldn't be a selection for agent or lender that you're just winging it and, oh, I'm just going to randomly work with this person and hope for the best. It's not going to work out.
No, I fully agree. And I think that's part of the whole like act early. Like the second you realize, like, I'm going to buy a house, I'm going to stop renting, get your team in place. Because what I see a lot of people do is, again, they'll find that perfect house on Zillow. They'll call the agent whose photo's attached to it, thinking that it's the listing agent, even though it's not. It's just somebody paying for ad
Yeah,
space. And that's who they'll end up working with. And then they'll probably be referred to like a Zillow recommended lender.
of course.
Again, like that's how people end up in situations where they end up with the wrong loan. They're putting in 15 offers without getting any of them accepted. And it just like that's where the home buying process becomes a nightmare. And it's just because they don't know any better. And there's so much noise. Our industry has so much noise,
Right.
right? I mean, I sit at home every single day and I get a new postcard from a new realtor. I get different refinance offers. You open up the mail and it's like, oh, instant offer. We'll give you this much money for your house. Well, if you're a seller that hasn't bought in the past few years, you probably have no idea what your home's worth.
You're right.
So
They
that
don't.
number might look really good to you. And every single time there's a bullet point. It's like save yourself real estate commission fees. It's like, well, if you used a realtor, you saved 20K, 30K, 40K in fees, and you got 100K less for your house.
Exactly. You didn't
But
get any exposure.
yeah, but there's so much of that noise out there and everything lacks context. Most homeowners, home buyers, they don't know what we know. So if they're not getting information that they should, they just don't know that they're not. If they're getting bad
You're
information,
right.
they don't know that it's bad information.
So if, let's say, I want to buy a house this year, do you recommend about 90 days before getting ready to actually start looking for a home and seeing homes? That's when I should be reaching out to you?
I mean, in a perfect world, it's as soon as you know you're going to make that decision. 6 months is probably more time than you need. I tell everybody, like when we pull credit and do a hard credit inquiry, that credit report's good for 120 days. So if you're pretty confident you'll find something and buy something within the next 4 months, then yes, reach out to me as a lender.
Get it
And
started.
yeah, and then I'm curious on your take. Who do you think they should reach out to first? Because this one's always controversial. The realtor or the lender?
I think they should reach out to the lender. I'd like to say agent, but I think lender. But if they don't know one that they trust and know is an expert, then they need to reach out to an agent they trust. Because that
Yeah.
agent's going to have preferred lenders that they know what they're talking about and get the job done and aren't going to put them at risk.
Yeah. And if you can find an experienced agent that's really good, they're going to work with an experienced lender that's really good because their
Yeah.
priority is to get transactions to the finish line in a way that generates future referrals, meaning they're going to get the transaction to the finish line and their client is going to be happy when they're there. And so,
Yeah, happy long term.
yeah, but I would agree with you. So, because when people reach out to me first, the biggest thing that we try to do is if there's anything people can do with their credit to improve it, it takes time. If we have to do deletion letters, if we have to validate debts, if we have to pay down accounts, it might take a couple months for everything to get done. And so if people wait till 30 days before, there might just not be enough time to do as much as we could have done with 90 to 120 days. Come to us, do your pre-approval. Let's get the credit run, get you in the best possible position. Let's say this is where your credit score can get to. Let's get it there before you find the house. And again, it's going to save people thousands of dollars. Sometimes just a little bit of legwork and a little bit of time
Mhm.
can save a substantial amount of money.
And even if they are just, pristine, nothing needs to be done. There's no harm in starting the process and giving yourself some runway. It doesn't have to be this rushed, stressful process.
Yeah. And I'm curious if you agree, because my take on that is this is what I see happen all the time. I will talk to somebody that comes to me and they say, hey, we're thinking about buying a house in 6 months. We wanted to get started early. And then every single time without fail, somebody does that. And the following week, they say, hey, this house just popped up and it looks like it's our dream home and we might want to make an offer on it.
Every
Can, can,
time.
can we speed things up? That's every single time. And so, yeah, even if you are pristine, it's like just get the process started early, because if that perfect home does pop up, you want to be able to act,
You're ready.
and you want to be able to act
Exactly.
confidently, and you want to be able to just go in and say like, hey, Amanda, can we go see this house? And if we like it, we're going to put an offer in today.
Yeah, I completely agree because the way the pace that the market is moving right now, you have to be prepared. You really don't have another option. It's not going to go well if you're not.
And so even if there's nothing to fix up credit wise, I mean, it could be a situation where people think they can use money that they just got. Like there's asset seasoning requirements too, right? So there's that whole
Mhm.
aspect of it where money has to be seasoned for 60 days. We need to see where large deposits come from. And so that's the other thing. Like if you're moving a lot of money around, if you got like a bonus or a gift or something like that, like we're going to have to document all that and paper trail all that. And that stuff takes time too. So the earlier on we know, we can handle all of that stuff in advance. It makes the process a ton easier once you find the house. So there's all of those things
Yeah.
too that people don't take into consideration.
It's all the details that go on behind the scenes that people just don't know. Not that they even should have to know. That's why it's so important to work with the right people because then you'll be guided every step of the way.
You kind of nailed it right there. It's like people just don't know what they don't know. But
Yeah.
if they start early and they work with the right people, they're very, very likely to save a ton of stress and also save a lot of money. So those are, I
Yeah,
mean,
the money factor. It's huge.
yeah, who doesn't want to do that? Who doesn't want to save money? Who doesn't want to have a less stressful process? Because buying a home can be super stressful in this market.
Absolutely. It can be really daunting. There's always going to be a little bit of stress, but you can save yourself so much stress if you just have the right team in place. And really, I think if you get one right, if you get the agent right or the lender right, the other pieces will fall into place because of who they know.
Yeah, I would agree. So I can tell early on, I just had an example where I knew the agent that was working with the buyer was inexperienced, and I wasn't doing the agent's job, but I was able to get the buyer to ask questions to their agent. I was basically able to like say, ask your agent about this, ask them if this is possible, ask them if maybe we should be doing this when we put offers in. And they were able to do that. And then basically that was the path we ended up taking. But they needed to just kind of be prodded in that direction because the agent just didn't know. And we're all new
Mhm.
to our
Yeah.
industry at some point, and we all know that getting licensed in our industry has very little to do with the day to day of what we do in our industry. So, new agents, there's wonderful new agents, but they don't know what they don't know. And so just having that information kind of relayed to them. And it's the same thing with a lender. If an agent knows that they're not getting communication from a lender, they're going to be like, hey, what's going on? I need to know where this loan is. We need to know what's happening so that we can communicate with the seller side and keep everybody happy and stable during what can be a very unstable course of
Yeah.
30
A
to
lot
45
can go
days.
wrong. There's a lot of people making everything happen to get to that closing table.
Yeah, and there's a lot of things that you can do, and they're usually simple things, but there's little small things you can do along the way that just make the transaction so much more seamless. And there's
Yeah.
little, small, insignificant things that you can do to completely derail a transaction too.
Yep. It's
And
very
they're
true.
and they're they're just as important to know how to avoid those things.
I completely agree. Is there anything else that you would like to share with today's home buyer that they should be looking out for, conscious of, or anything as far as it relates to the market as we wrap this up?
Again, going back to headlines, because the media is, I hate using the word like the enemy, but you're getting bad information if you just take what the media tells you. Because if you see the media say rates are expected to decline, forecasts or rates are going down, again, they don't do it on purpose, but they always lack the context that's necessary to make a good decision. You hear rates are going to come down. Well, it's like, well, shit, I'm going to wait until those rates are down.
Yep.
But what they don't talk about is how many extra buyers are coming into the market, how much more competition that's going to bring, what that's going to do to the price tag of a home. And yeah, you might save $200-300 because your rate's going to be lower, but you're going to be financing $25,000-30,000 more because you had to offer it to get the house under that situation. So I would say buyers just need to understand that thing. It's all context. There's no perfect scenario where you're going to get into the house with the lowest rate at the best price. It's not going to happen unless you get lucky, and you're not going to know you've gotten lucky until after the fact. You're not going to
Yep.
know until rates go up and home prices go up. You're not going to know when that perfect scenario occurs because the only time you're going to see that perfect scenario is in hindsight.
Yeah. Timing the market is impossible.
Yeah. And people try it all the time. And on the other side of it too, they say like, is it a bubble? Our market's going up, our price is too high. And that causes a lot of buyers to hesitate. But if you follow a lot of the media, they've been saying prices are too high since 2013.
Yes.
We came out of the crash and people have been saying like, oh, prices went up too much. We're due for another bubble. Well, prices kept climbing in 2014, 15, 16, 17, 18, 19, 20, 21. Just 20 and 21, they went up 40, almost 40% in 2 years.
Yeah.
In 2 years. And they said it was a bubble. And then in 2022, prices went up again.
Exactly. But they're not looking at, I think they're just saying it because prices are going up, and that's not what the bubble was.
Yeah,
If you
the
had a
bubble.
pulse, you could get a mortgage.
Yes. So there was that. The other thing, so we showed that demographic. We showed household formations earlier in this conversation versus completions. If you go back to 2006, that graphic was completely flipped. Household completions were sky high and household formations were very, very low based just on demographic data. If you think about it, the first time home buyer age has not changed. The average first time home buyers in their early 30s, and that's been the case, and it's changed from like 32 to 34. That's changed, but it's still people in their early 30s. So if you just go back and look at birth death rates and you just look at how many people were born 30 years ago, you kind of know how many first time home buyers are about to come to the market. And if you do that from 2006, you'll notice there was a period of time when the amount of births in the US took a big dip and the amount of people being born was much lower than previous years. And then once that demographic, which was a smaller demographic, reached the age of first time home buyers, there were less buyers, but builders weren't paying attention to that. So they were building spec housing and builders were saying values keep going up. This was at the time when everybody said home values never come down. Home
Mm,
values are the one thing that never come down. And so builders just kept building for a whole demographic of buyers that weren't going to come to the market because they weren't born.
they weren't there.
They weren't
Didn't
there.
exist.
But then if you look at birth rates going forward, it's a consistent uptrend. That's why the millennials were such a huge generation. And that's why Gen Z is going to be an enormous generation. And whatever we're calling the post Gen Z, I forget what that is. It's going to be a steady uptrend in population demographics and people that need housing. And we didn't have that in
Yeah.
2006.
It's going to keep the demand there.
The demand's going to be there, and supply, I hate to say it, but it's like if you want to live in a desirable area, and I don't mean desirable like within a community, but like if you want to live not in the middle of nowhere, right? If you want to
Yeah.
have restaurants and entertainment or mountains or beaches, there's only so many places in the country that have that. There's only so much land. The longer you wait, the further out from those things you're going to be.
I
And
like that you
that's
make that point. There's only so much land. That's powerful. They're not making more land.
Yep. And agree or disagree with what the country's direction is in terms of environmental protections, they're making it harder to build on that land. They're making it
That's a
harder
good
to
point.
permit on that land. They're making it harder to build the same way you used to be able to build on that land. So zoning laws are changing. I don't know about your area, but what I'm seeing is you used to be able to get relatively close to a city. You could get within a day trip from a city and get an acre of land, decent size house. And now you can still get relatively close to a city. You can get a decent size house, but your kitchen window is this close to your neighbor's kitchen window. And that's the way that
Yeah.
every community is being built right now. And
Yeah, it's
so
these massive homes on a postage size stamp lot. They're tiny.
and that's what developers are doing now. Nobody's offering those giant plots of land in convenient locations. So it's like, again, if you want a single family home with a yard, there's only so much space. There's only so many of them available. There's only so many 1 acre plots, right? So it's just it just doesn't help. It doesn't help you get into the situation you want to be in. And I don't see any way we get out of that inventory crunch. because there's only so much land. Builders can only build so quickly. There's only so many permits being issued. Environmental inspections take forever. And if there's environmental issues or impacts to an area, that further delays things. So it's like housing creation is not a problem that can be solved quickly.
I completely agree. And I think that it's really important also. This is all based off of data. The news likes to speculate and love them or hate them, whatever your opinion is. They're not basing what they're saying off of data. And all of this can be explained through numbers and history.
And it's the context. The context is important. I think it was Mark Twain who basically said there's lies, there's damned lies, and then there's statistics. And so, again, if you look at the media headline that says inventory is climbing, well, if I just look at that and I just take that headline, inventory is climbing, that means supply is going up. When there's more supply than demand, it means prices go down. So if supply is going up, it means prices should come down. They fail to lack the context of the glut of buyers we have, or that inventory is climbing. They forget to mention that it's climbing, but still 50% of what it was in 2019, and probably 60% less than we need for a balanced supply and demand market. That's the part that they don't mention. We take the data and we take the context. We look at big picture. We look at things like birth death rates. We look at things like single family housing permits. And we also look at what the economy is doing in terms of what the Fed's doing, because guess what? Builders need to borrow money. Banks need to finance these developments. And there's going to be fewer builders building when the rates that they're borrowing are sky high. They're going to be able to borrow less. They're going to be able to do less. And that's how the Fed impacts the economy and how quickly or slowly things happen and occur. So we look at all of these things because they're all important when we give advice. And that's, for me, I want our home buyers to understand these things, maybe not at a granular level that we do, but I want them to be confident in the market. And I want them to understand why they should be confident in the market. I don't want them to tell all their friends, like, we bought a house and it's going to help our wealth because a headline told me so. I want them to really understand and be comfortable with the fact that why is it a good decision to buy today?
I think that is something that sets you apart. You have always taken the approach of educating your clients to understand, and you take data that is difficult to understand, and I would say difficult to explain, but you do it in a way that's easy to understand, and it empowers them to make the decision that they feel is best for themselves.
I appreciate that. And I have a lot of help. We invest in systems and I invest in this data, right? Like, this stuff costs money to see all this. I can get the data for any market in the US. It costs money, which is also why I tell people, like, I'm not the lowest rate. If you want the lowest rate, I can tell you exactly where to get it. You're going to go to the internet. You're going to work with a loan officer that was in high school last week. You're going to, like, it's like that's what you're going to do if you want the lowest rate. We're going to be competitive, but I do invest in these things. I invest in systems so that I have this data so that I can give good advice. So I have a lot of help in that way, but the data's out there. You just have to understand it. And I don't think a lot of people take the time to understand it, unfortunately.
No, I don't either. And I think a lot of buyers also, the rate might be slightly better, but are you actually going to close? Is that lender going to be able to deliver? And a lot of times when it comes to these online lenders, the answer is no. And then you have a whole other slew of problems on your hands.
Yeah. And that's the other thing. You don't want to work with a lender that, there's a lot of lenders that just don't know their products, and one of the scary things I will say today that, this is kind of it's not necessarily a buyer mistake. I think this is an industry mistake. And it's just kind of where we've headed as society. We give so much credit to influencers. And so I see there's a lot of lenders out there right now, a lot of loan officers that are on social media, and they're really, really, really good at social media. The scary part is they're better at social media than they are at knowing their industry. And so they make a really, really good video. And I just saw it the other day. Somebody put out a video and it was just totally incorrect information. And it looked good. It was really well edited. It looked wonderful. And she's an influencer on, I think it's TikTok is what she focuses on. But the information she's putting out there is bad. And she's got thousands of followers that are eating it up. So it's tough. And it's tough for buyers. It's tough for people to find sources they can trust. That's why conversations like this are important, because a good loan officer, a good lender has to understand these things. I can't just provide you the data. I need to be able to understand it and provide context to it. And if you don't feel comfortable that I can do that, then you should be working with somebody else, because I might just be parroting something somebody else told me somewhere if I can't explain it and walk you through it. And that's why the conversation and the questions are so important.
I agree. Thank you so much for your time today. I really appreciate you sharing your insight. And I obviously refer clients to you regularly, but I also want to mention that you are who my husband and I obviously go to for our financing as well. That's how much trust I have in you. And if anybody watching wants to reach out to you, I'm going to include your contact info in the description below. And I know that you are happy to answer questions and help people with their home buying journey.
Yeah, thank you for that. And I really appreciate that. The other thing that I would just add is, people have questions sometimes. Maybe they're not buying a house. Maybe they have a question. Maybe they're a homeowner and they have a question. Or maybe they're working with another lender and they're not sure about something. I'm happy to help people. I want home buyers to be empowered. I don't want them to spend money they don't have to. And I certainly don't want them wasting their time. So I'm always happy to answer questions, and I make myself pretty available to anybody that needs help.
I appreciate it, John. Thank you.
All right. Thank you. I appreciate you having me on.